Okay, good morning, good afternoon, wherever you are. I'd like to welcome a brand new fund manager to our series of the Coffee Microcaps Microcap Fund Manager interview series. You might have seen our last video with Steve McCarthy from DMX, and today I am delighted to be joined by Richard Ivers and Mike Younger. Anybody who's been around microcap, small caps in the Australian market for a while probably have ran into Mike and Richard at some point. Gentlemen, how are you?
Yeah, very
Good,
well,
thanks,
thank
Brad. Thanks for having us. Yeah.
Prime value, business been around for a long time, but excitingly now there is a microcap fund that has also been around for a while, but is now kind of getting opened up more broadly. So I don't know, Richard or Mike, whichever one wants to kind of just give us a bit of the backstory on the fund and kind of where it is now as we kick off the new financial year.
No worries. I'll give it a start. So, yeah, Prime Value, as you said, Mark's been around since 1998. So it's a long established business across multiple asset classes. The Microcap Fund has actually been operating since 2015, so almost 10 years. Myself and Mike and Ben's the third member of our team. At least one of us has been running the fund since 2018. So we've got coming up around 7, 8 years experience or track record on that fund. It's been wholesale to date. And so it's now been made available retail, literally from the 1st of July. So it's brand new from that perspective. And what that means in practical terms, apart from, risk and compliance terms, is that you can invest with a minimum of $20,000 and you can invest through our website as opposed to needing $500,000 and being a sophisticated investor and going through sort of more rigorous compliance processes to invest in the fund. So it's much more widely available, as you said. The good thing about it is you're investing in a retail fund structure now, but it has a long track record and a track record of consistent outperformance over that time. So it's not a new fund which you're not sure how it's going to perform. It's done really well over that time. It's got an existing team that's been running it for many years, as I said, and a process that's well established, and a portfolio that's up and running, and is well positioned, we think, for returns in future years.
Maybe if we just touch on it, maybe Mike, portfolio in broad strokes, anything you don't look at, is resources in there, not in there, size of what you guys define as a microcap. I know there's no real hard and fast definition in Australia. People kind of slice it and dice in different ways, but maybe just the universe that you start off with, maybe just give people an overview from that point of view.
Yeah, sure. So at first purchase, we define microcap as less than $500 million market cap. So it's fine if we invest in a company below 500 million and it continues to grow beyond that. We can hold on to it, but the first purchase has to be below 500 million. That's how we define it. In terms of what we rule in or out, our process is such that we tend to rule out resource companies, which can be a large part of the market. But the process is really about trying to select stocks that we have a relatively high degree of confidence in what their profit is going to be over a 3 to 5 year time frame. We model them out, and we can tolerate being wrong to the tune of 5, maybe even 10% a year for some stocks, modeling out for 3 to 5 years. With a resource stock, we just simply can't do it. We can't even do it within 1 year, get within 10%, let alone over 3 to 5 years to getting within 10% compound. So we tend to rule out resources for that reason. And things can go wrong for many reasons beyond management's control in that particular space. The other area we're a bit cautious on playing in is in that sort of unprofitable biotech space, where it does tend to be a little bit more binary as to which way the pendulum is going to swing. There's a lot of work that we could try to do to try and understand some of these companies, but we probably conclude at the end of that we still don't understand them well enough. So there are a couple of areas we tend to steer clear of.
Yeah, and I think Coffee Microcaps through the years, we we've kind of focused on those more industrial stocks rather than resources and biotech as well. So I think you'll definitely be talking to people who are kind of on the same wavelength. Not to say you can't make money in the resources and biotech, but I think it's a very kind of specialized part of the market, especially down this end. Two stocks we're going to chat about in the portfolio today. First, a newish one and one that's kind of, been well established on the boards for a while now. So we'll start with that one. Australian Finance Group, most people just refer to it as AFG. What was kind of the initial, thesis that kind of got you interested? As I said, it's kind of been, I think, and they must be around 2013, 2014. I think I remember them listing. They've definitely been around for about a decade. So what kind of in the more recent times has kind of attracted the fund to investing in AFG?
Yeah, so we've held it for many years in the fund, but we really increased the position size quite a lot around 12 months ago. And the reason for that is maybe I'll give you a quick description of the business. Should I? That might
Yeah,
help.
yeah.
So you've kind of got 80% of the business is what we would call a distribution business, which is your typical mortgage broking business, whereby 75% of all residential mortgages in Australia are taken or processed through mortgage brokers these days, as opposed to going directly to a lender. Banks are shutting their branches, and so there's less availability and less distribution by the banks. And it's just a greater experience for mortgagees as well. When you go to a broker and you've got a smorgasbord of options whereby you can find the mortgage that's most suitable to your needs and the best price. So there's been a real shift in the market towards brokers. So that's 80% of the business, and that's kind of a relatively consistent, moderately growing, but moderately growing recurring revenue type business. And then the other 20% of the business is what we would call the manufacturing business, whereby they actually write loans themselves, and a bit like a bank does. And the profits of that business is driven by the volume, so the size of the lending book, and then the net interest margin that they make on that book, a bit like a bank. And coming back to your original question, why we like it and why we've basically increased the weighting. So we like that recurring revenue side of the business, the 80%. But what's really quite exciting at the moment is the manufacturing side. So that's had quite a tough period through COVID. But about 2 years ago, the mortgage book really bottomed out, whereby the banks were competing very, very hard. They got cheap funding from the government through what was called the TFF, basically very, very low cost of debt funding, whereby they could then provide cheap loans to mortgagees. And you saw widely offered cashbacks to people who are looking to take out a mortgage. And in that environment, the non-bank lenders like AFG didn't have that same level of cheap funding, so they just couldn't compete. And so the book actually declined over time. Now that funding from the bank that the banks had, that cheap funding ceased, was roughly about 3 years term, and so those cashbacks ceased offering, and the playing field leveled out, whereby the non-banks could compete again for volumes. And so you've seen AFG's volumes really start to accelerate. And the net interest margin that they're making on that book is also bottoming out and starting to rise again as well. And AFG actually releases a mortgage index, which they actually put out last week, and that's based on lodgements as opposed to actually applications that have been approved. It's lodgement, so somebody who's lodging an application for a loan. So that's a real leading indicator, right? So you get to see before the book actually grows what's happening, and you can see that the volumes are rising. They're rising quite quick. And so we're quite excited about the earnings growth that is coming through in that side of the business, which is really going to start to accelerate growth for the overall business. And then you've got things like interest rate cuts, which benefit both the distribution side of the business because you get more volumes, people are taking out, buying more houses, and lending growth will accelerate, which helps that, the distribution. But then on a manufacturing side, where they write their own loans, that they also get more volumes, but they also are able to keep a little bit of that net interest margin. So when rates are cut, they pass on most of it, but typically not all of it. So they keep a little bit of that interest margin as well. So, you've got the volumes improving, you've got interest rate cuts providing another accelerator, and then you've got a bunch of other earnings drivers that are coming through as well, whereby they've just gone through a big capex phase of investing in technology and the like. That's driving efficiencies in their business, but also enabling them to sell more services to mortgage brokers that are in their network. And then to add a sort of cherry on the top, if you like, there's even more. They're going out and they're basically doing a model whereby they are investing in some of the brokers themselves. We're a bit like an Oz brokers, where they take an equity stake in the mortgage broker, and typically it's a non-controlling stake, but it provides capital for that broker to help them grow, and they get a good return on that investment that they make. So there's multiple drivers, and then you sort of wrap it up and you look at valuation, and it's trading on about 14 times earnings for FY26. The market's on about 18, 19 times, and historically AFG's traded on sort of a range of 7 to 17 times. That's kind of in the middle of that range. But as I said, earnings growth is really starting to accelerate. And that multiple is based on consensus, and we think there's upside risk to consensus forecasts over the next 12 to 24 months as well. So it's looking good from a valuation perspective too.
Yeah. And maybe if we, touch on the other side of the ledger, risks, kind of being with their fingers in many pies, does it cause a bit of stress with, the banks or the brokers that they're kind of, trying to have their cake and eat it? And of course, it hasn't really played out, but I mean, as we exited COVID and rates started to rise in response to, inflation that we saw in the economy, the whole mortgage cliff was a big story for a long time, but the banks have seemed to manage that through, or at least their customers have definitely seemed to manage it through. So that hasn't really kind of come to the fore, or it's kind of a dead issue, I think, at this point, given how far along we are into the refinancing process. So maybe touch on maybe what are kind of maybe slight concerns or things that wouldn't look great if you started seeing them chatting about the results are going to come out, or any of their commentary coming through in the next kind of 12 months.
Sure, yeah. And you've touched on, the lending book and the quality of that book and the risks around, repayment of loans by lenders, and that is definitely a risk. So AFG typically they take on a loan on their own balance sheet or through warehouses, and then they term that out through the RMBS market. But they do still keep exposure to those loans, an element of exposure to those loans. So there is exposure to loan losses. Now the AFG is one of the more conservative non-banks in the market when they lend. And that was illustrated by the fact that, when they couldn't compete, they didn't just go out and try to offer, go into the riskier parts of the market like some other non-banks did. They actually shrunk the book. So they've been relatively conservative and proven that over time. But, as you also highlighted, I think that the risk of that is really dissipating with interest rate cuts coming through, that should support economic growth and reduce payments that are required. So that I don't think we'd see that as, the loan loss record of AFG has been exceptional, and that risk is dissipating. So we don't see that as a big risk. Probably the big risks are things like, the banks, the majors in particular, cutting commissions that they pay the mortgage brokers. So that hasn't happened since the GFC, and there's constantly talk about it. But as I highlighted, the banks have been cutting their branches, and they're basically moving from a fixed cost model of having branches to a variable cost model whereby they pay brokers a commission on the volumes that are written through them. And the banks, they write a little bit less than the overall market, so typically between 60 and 70% of the majors comes from brokers. CBA is a bit lower, but then on the other side, you've got things like Macquarie that actually close to 100% comes from brokers. So there is the risk of them cutting commissions, but they would, they're basically risking their core business by doing that. I mean, residential mortgages are core to the banks, and the more regional banks, like the Bendigo and I said Macquarie and many other lenders out there. So there's a risk they'll be risking their own business. We don't think that's a major risk. I mean, there's always risks of things like, the market becoming more competitive as well, as we saw through COVID, where, the manufacturing book shrunk. So, I think they're probably the three main risks that we would highlight. As you said, the loan book, the commissions being cut, and competition in terms of competition for mortgages out there.
And then if we look, what are you kind of looking for as either a catalyst or kind of, key announcements from them as we push into FY26? Is it, when the result comes out, probably the back end of August? Is it, what's really happening in the manufacturing book? Okay, we glance over the distribution business to make sure it's ticking along, but it's really the seasoning of that book on the manufacturing side with, what the net margin is, credit loss ratios, the kind of three big things. Is that kind of the key stuff to look out for in the near term?
Yeah, I think credit losses will be very low, as I've highlighted. I think that's not so much a risk, and the book, we've got a reasonable insight because they do put out that mortgage
Mm.
index, and they give you some breadcrumbs in terms of what they're writing themselves in the security side. So you can kind of work it out roughly where the book will end. The net interest margin that you highlighted is important, and that hasn't been disclosed. So you've got to look at what's going on in competition and the like to get an assessment of where that will land. So that is important. So that's the manufacturing side of the business. As I said, the 20% of the current earnings, but the bit that's really going to start to grow. And then, the other thing will be on the distribution side of the business. So how that is going, the size of the network, the revenues that they're getting. So they take a clip of the ticket on the commissions that they generate through the brokers, but they're also selling services into those brokers. Like things like technology that helps them process loans much quicker, that saves brokers time. And so that side of the business is really starting to grow more into a really true recurring revenue side, a sort of a fixed monthly fee type basis, which again is even higher quality. So that's all starting to improve as well. Then they've got some guidance numbers out for FY29. Things like cost to income falling from 70% to below 50%, which in 4 years' time is a massive potential earnings driver. So an update on how they're moving on those guidance numbers will be important as well, to show that they're on that trajectory. And if they hit those guidance numbers or aspirational targets more than guidance, consensus will be beaten well and truly. So when we look at consensus, we think it's relatively conservative looking out. But again, we haven't got the aspirational targets in our numbers either. So if they hit aspirational numbers that the company put out there, that would be really, really quite exciting for the business.
Yeah, and obviously that cost income, if it does fall, as you say, from 70 odd to 50 odd, I mean, the flow through of that into return on equity and everything is going to be even more amplified. All right, one I haven't looked at in a while, probably worth a review. The second one we want to talk about is one listed the back end of last year. Cuscal got a lot of chat in the market. We've been in a bit of a drought period for IPOs, so anything that does come to market gets a fair bit of airplay. But maybe if we just take a step back and just give a quick overview of, the Cuscal business and how these guys make their money, because it's I think a bit far removed from the everyday person and the everyday economy. It's a very much back end B2B business as opposed to, AFG, where people kind of can get their head around it, or maybe have engaged with a broker that is supported by AFG.
Yeah, absolutely. It's one that really sort of sits in the background of the payments industry, if you like. And it's a company that's been around for a very, very long time. Started out as a mutual actually, but it's what we call a payments infrastructure business. And so that makes it relatively unique from an ASX listed perspective to be able to get a pure play exposure on this. And what it means is that they connect to the payment rails of Australia. And it's a privileged position across the gamut of different payment method types. There's only 5 organisations in Australia that actually have direct connectivity with the payment rails. And it's Cuscal plus the 4 major banks. And so what you tend to find is that other banks tend to like to partner with Cuscal to get that processing and clearing of their transactions rather than using the major banks because they're the companies they're trying to compete with. So it's really quite a privileged position, and there's quite high barriers to entry to it as well, in that you need to be an ADI, which means you have to carry a lot of capital on your balance sheet. So Cuscal as a business has something like a $500 million-ish market cap, but it actually carries in excess of 250 million of its own cash sitting on balance sheet because it has to, it's regulated. And so to get to the guts of how it makes money, it will sit between the company taking a payment transaction, whether that is a withdrawal from an ATM, it might be tapping your phone with Apple Pay, using your credit card, debit card, batch payments, new payments platforms, sort of pay ID type payments, and actually transferring those funds to where they need to go and ensuring settlement happens. And the way they get paid is by the volume of transactions, which is quite interesting because what you tend to find now, because of the convenience of paying on your phone, for example, you're finding that there is now a lot more transactions that tend to be of lower value than what you used to have before. And so if you went back 10 years, people typically wouldn't pull out a credit card to pay for a cup of coffee. But today, you've got Apple Pay enabled on your phone and you just wave it over the square terminal at the cafe and you're paying for your coffee with it. So the average value of transactions is falling as the volume rises quite significantly. And so there's a really nice tailwind from an industry perspective of the volume of transactions, and Cuscal is paid predominantly based on the volume of transactions that are processed.
And Mike, we've seen, a lot of chat, especially in the last 2 weeks on, payment surcharges, coming into the market, and not to mention, it's been an ongoing process by the RBA, modernizing, Australia's payment infrastructure. We've seen lots of updates on, trying to get real-time payments, faster settlements, all of that. Maybe just touch on, how these broader dynamics within the payment industry feed into Cuscal's business, either on the positive or on the negative.
Yeah. Typically, these things are I say, positive for them in that they are almost ambiguous as to what form of payment occurs in the market, and it's an industry which is really quite nascent. We're finding new technologies all the time. I mean, again, you go back 10 years and there wasn't a square terminal sitting inside a cafe that you could pay with. You had the typical old sort of FPOS machines that were sitting there. You got Apple that's now waded into the space and is enabling you to pay by your phone, or Samsung. But all of these, at the end of the day, all of these payment types need to be processed and cleared and settled. And so they need to connect to someone who has the direct access to the payment rails to do so. So the risk of new technology as it continues to emerge, no doubt that will happen, but it still needs to find a way to connect with someone who has access to the direct payment rails of Australia. And Cuscal, as I say, for the vast variety of transaction types available, are one of only 5 parties that directly connect. And so particularly when you've got these companies that are coming in and wanting to compete with the banks for transactions, Cuscal is a really nice option for them to use rather than funding a competitor, if you like. There will be negatives, and I guess when we talk about risks, things like scams in the payments industry are a major risk. Cuscal is not immune to it, but as a B2B provider, they're less directly exposed. And so what you would tend to find is if there was a fraudulent transaction that happened somewhere, it's more likely to have come from a customer of Cuscal or a customer of one of the major banks, allowing that transaction to come in, as opposed to it being a direct issue for the processor. And this is something which requires continual ongoing monitoring and enforcement, and it is something that costs money. And so the CapEx bills of Cuscal can be quite variable as a result. APRA and ASIC are always looking very closely at these things and requiring all ADIs to invest significantly to continue to improve their governance.
Yeah, I'm sure cybersecurity is not a small cost line on their P&L, especially when you're so integral to the broader network. As you say, if there's only 5 providers. As I said at the outset, they only came to market the back end of last year. So this result we're going to see now in August is going to be the first full year, 12 months as a listed entity at least. What are you kind of looking for? Is it more, hitting the prospectus pro forma numbers, or are you kind of more interested in, what the kind of broader, longer term outlook is? If it is like what they're talking about in terms of volumes or added services maybe that they can provide to. I'm thinking of some of these like big fintech players like the Air Wallets of the world. People who are trying to come in and offer a very slick, differentiated service as an alternative to some of the traditional banking products that personal or business customers would have taken up from a NAB or a CBA or Westpac in the past.
Yeah, but for a newly listed company, it's integral they hit their prospectus numbers. They intimated at their first result 6 months ago, the half year, that they're tracking to or modestly ahead of it. And part of that is around the cost base. It's been taking a little longer to hire people directly, and so there's a little bit of a give and take with direct hires versus using contractors to fulfil certain tasks. And so they might get a little bit of a fill-up in this period when it comes to that cost base. So the guidance around what they're talking to on operating costs going into next year is important. Of course, the underlying trends, we want to see that the underlying trends are continuing. And while it is their first full year result as a listed company, we do have 11 years of historical data that we've got access to. And so this is a business that's been a very steady grower over time. Over that 11-year period, NPAT has grown at 12% per annum, and it's been really very consistent. So what we're looking for again is around that mark. We expect to see transaction volumes typically running around the 7% per annum type level, which really drives their revenue. And then as you get operating leverage going down the P&L, you can get to that high single, low double digit bottom line outcome. So we're looking for that. Also looking for some commentary around, as you highlight, the RBA payments review, where they put out a consultation paper last week. There will be submissions that various parties make over the next month or two that the RBA they would then take into account and announce down the track later this year as to what the next steps will be. But to hear some commentary around them, I mean, we expect that it's not going to be anything that moves the needle for Cuscal either way, because they don't take a piece of the surcharge, whether it's debit card or credit card. There is potential down the track that there could be a squeezing of margins to the entire supply chain, of which Cuscal is part of, as contracts are renewed with their banking customers, if those customers are looking to claw back lost interchange fees throughout the supply chain. But that's something we won't know for sure for quite some time, but just some commentary as to how they expect it to play out from what's being put forward in front of us is quite important too. And then the other element is around acquisitions, because one of their smaller competitors has recently appointed an investment bank to undertake a strategic review, and it's an entity which, if you were to see Cuscal come in and make a bid for, it would be very significantly accretive without knowing what price they might pay. There is a lot of cost synergy in putting two payments infrastructure businesses together.
Yeah, like
So
the consolidation we saw in the in the early days of the telecoms businesses where you'd all these IP providers and they all amalgamated up, but the like cost synergies were like just huge when you're just running backhaul over the one line. And I can imagine it's the same in the payments industry. Yeah, the surcharge is going to be interesting, especially I was flicking over, not that I look at mega caps too often, but reading a story about what Jamie Dimon was saying in the States now, JP Morgan are going to start charging a lot of these fintechs for, interchange fees for accessing their, so I'm accessing their JP Morgan customer accounts, whereas previously they haven't charged for it. So I'm sure the CEOs of the Australian banks will be looking at what the fallout from that is once JPM in the US start pushing it through. Maybe just to wrap up, Richard, if people want to find out more about the prime value, house of funds, family of funds, and the microcap fund in particular, where is the best place to, get in touch with yourself or Mike or, the team at Prime Value?
Yeah, sure. So there's the website is a great way to find resources, man, all our monthly updates and the like, and application forms, all sorts of things are on the website. So that's primevalue.com.au. Um, our number, we're Melbourne based, is 03 9098 8088, and we have a client services team who can help too. So it's easy just to call through. And then just the last thing I'd say is kind of when our team, we run the microcap fund. We also run a small cap fund, which is called the Emerging Opportunities Fund, and has won awards and the like. Is reasonably well known. We think is another one that maybe the small cap investors are more interested in, as opposed to microcap. And then how we differentiate a bit, if I might just provide some details on that. Like I think in microcaps, there's a broad range of companies. So you can have everything from exploration companies, and biotechs like Mike highlighted that are trying to cure cancer, and it's a binary outcome. Like we saw, we've seen some of those binary outcomes for biotechs, like Opthea and recently. We don't really play in that space. We play more in the established businesses space. So we're still in the microcaps and exciting, and they're growing fast in niche areas of the market, but they're typically business models that are proven. So we play in, I guess you could say, the lower risk area of microcaps, but still looking for the fast growth and the ones that can be 5 or 10 baggers over time.
Yeah, no, exactly. There's no shortage of choice down there. I think the last time I looked, there was 1,600 stocks capped under 300 or 400 million. So there's definitely a wide universe. Even saying, given Australia's history in mining, even if you take out the resources sector, there's still a plethora of opportunities down this end. That's why we love it. That's why we do what we do here at Coffee Microcaps. Mike and Richard, it was great to have you on. Hopefully we can get you back in maybe the back end of 2025 or early 2026. And yeah, good luck with the marketing of the new fund. It's great to, I won't say new fund, new to retail investors. It's great to have a bit more opportunity and choice among the funds on offer in this space. And yeah, good luck for reporting season.
thanks very much, Mark. Thanks for having us.
Thanks, Mark.